Do you think life is simpler as time evolves? For some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why Attorney-CPA Joe Cordell hosts ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Welcome to another episode of ElderTalk. We continue with part 2 of our segment on market projections for 2021. Joining us again is Louis Wray, the founder and wealth manager of Vine Wealth Management. Louis, I'm curious, what do you expect to happen with the big tech companies this year? You have so many conservatives leaving social media platforms such as Facebook, Twitter, and going to the lesser knowns like Parler and what's the other one, Cloud Hub. And of course, Parler is kind of up in the air as we speak. But what do you expect to happen?
You still have to understand that technology, as we know it today, is absorbing all of the changes in how we do business. So technology is able to grow and expand and recreate itself, because that's what's defining our productivity, our way, just the way we communicate, things of that nature. So they're in a sweet spot. They are in a sweet spot. This is not just a one-time product that somebody else is going to produce another product. Quite frankly, they understand technology. They understand their industry. When they start to see someone maybe become a little more competitive, the bigger ones, the big FANGs and the big Facebooks and the Amazons, they just buy the company, buy the technology. So it is still a place to have your money. I wouldn't want to get in a fight with those guys as far as trying to compare return in one area versus the other. Are they somewhat optimistic in their share prices? Yes. And I think there are some that are more in the crosshairs of legislation and just how people feel about them that maybe warrant a little lighting of the investment. So if I was going to look at technology today, which we still are still somewhat heavy technology, not heavy, but we still believe in it, quite frankly. I wouldn't want to trade technology, the good technology. It's here for a long time. I mean, good luck trading Apple. You'd have been a heck of a lot better off just owning Apple. Okay, Amazon, those types of companies. But I do think that we are recommending that there is some things going on in technology right now. Valuations aren't near what they were a year ago. And you've got regulation. You've got some of this political movement and people just being upset with how information is and is not shared across certain types of platforms, one of which is certainly Twitter, which is our buddy from St. Louis who's looking crazier and crazier. I'm not sure what his deal is.
Yeah,
Jack Dorsey.
He's been stuck in a deserted island for many years here.
Yeah.
But
well, they all look strange.
Yeah.
I've read articles about this recently. There's something about those guys. Zuckerberg. I mean, is he? He doesn't seem almost completely warm and human. He's aloof, robotic.
Mm-hmm.
They're in a different reality than the rest of us, I think.
Yeah.
But
they're almost artsy. They're kind of artsy in how they, you know what I'm saying? It's a little different type of businessman, that's for sure.
Tech artsy.
Yeah, tech artsy.
Yeah. And I think, though, I'm spooked by some of the largest investments in terms of the tech industry, just those that have these PE ratios of in excess of 100, for example. I mean, Tesla's over 100. I thought it was 120 to 1, isn't it?
I thought it was a lot higher than that.
Well, I don't believe it.
Honestly, we don't own Tesla. I'm not saying there's anything wrong with Elon Musk. I'm not saying there's anything wrong with Tesla. It's Tesla, the stock, that is the issue.
I know, and that's the way I feel, is that do I think Tesla's a good company? Of course. And I'm actually a fan of Elon Musk. I think he's a little crazy, but I'm a fan of his because he's been such a great leader and he's done wonderful things, SpaceX included. But when I look at the PE ratio, whatever it is, we know it's way up there. And I think that it's just too high. And even Elon Musk, to his credit, made the statement that their stock was too high. First time a CEO in corporate history has ever done such a thing.
Who'd have thought?
Yeah, but even he thought that at one point it's too high. But now, I mean, because of this stratospheric price, he's one of the richest. He is the richest man in the world currently. But I tell you, though, regarding Facebook and regarding less so Amazon, but I'd say Facebook and Google are the ones who primarily face huge legislative downdrafts. And I think that you couple the litigation that's going on from the private sector as well as the Justice Department. Look at what's going on in EU, the determination to tax those transactions that are occurring there. That'll affect all of the tech industry. But I think especially when you look at Google and Facebook, I mean, there are just a lot of problems that they have, a lot of outrage on the left and right. I think they're looking at some sort of major legislative action. And it could be very much like what happened to Standard Oil around the turn of the century when the antitrust legislation was first passed around the turn of the previous century. And Standard Oil was broken up into, I think, 6 different companies, all of which incidentally thrived. Standard Oil of Ohio, Standard Oil of Indiana.
Right.
And one became Exxon.
The Baby Bells, when they broke up, I mean, that would have been a great trade, much better than holding it all in AT&T.
Yeah, same thing. So some have talked about that being the solution for the situation with Google or Facebook, but I do think something like that's coming down the road. And it could just be very harsh legislation that just makes it less profitable. But I don't think that the world, and this isn't just the United States, even if they slide with the Biden administration, which they won't, in my opinion, they're not going to slide with Europe. So I think that they're both looking at having to make major changes in the future that I think will reduce profit in the short term, at least.
And I think the antitrust rules were written, when they were written, this whole thing of virtual technology and being able to jump in and express your thoughts in different ways and being able to then see who becomes popular and then control that popularity on your own based on your own opinions. That kind of verbiage is not largely the way I understand. I haven't you would know better than I would, but it's not built into the antitrust laws today that we have. They need to be modified, and I think they're going to be modified. Yeah,
they are dated. Regarding, though, anti-competitive actions, though, which is a little different because it can be on a smaller setting. It can be a particular industry or a part of an industry. When you think of the major publishers such as Simon Schuster, McGraw-Hill, and others, and these were at one time major industries, not to mention the newspapers. And much of both of those industries have been supplanted in large part by Amazon. And so now Amazon is in the crosshairs of the Justice Department. And apparently all that's necessary to show that there's been some sort of price fixing is an agreement between the companies, the parties, an agreement. So there has to be an overt discussion. There has to actually be an implementation of a policy. And number 3, there has to be harm to the consumer. And harm to the consumer is established by, for example, a higher price. And all 3 of those elements are established for purposes of that one piece of litigation, which could cost them billions of dollars if it's successful, and it appears like it's going to be, and I suspect they'll settle. So when I look at big tech, I look at a lot of friction from a lot of directions because they're so big and so powerful, especially Amazon, Google, and Facebook.
I'm reducing my positions in big tech, okay, but I'm not wanting to jump out of that area just because that industry is alive. But there's companies like Microsoft, there's companies like Salesforce. There's a lot of good companies who really aren't involved in all that stuff to any large degree.
A lot of them, you're right. Your point is, and I agree completely. I'm not pouring cold water on tech. I mean, tech is the future. And I would even argue that these companies are so big and so powerful, and I would argue so good in terms of delivering wonderful services and products that I think the probability is they're going to land on their feet. whatever happens,
Without a doubt.
yeah, they'll land on their feet. Maybe they won't be quite as lush, but it's like imagining Standard Oil with the necessity of oil in an industrial revolution, and they had control of the vast quantities of the oil supply in the United States and starting to appear in the Gulf. So in that period of time, it wasn't possible to take Standard Oil and impoverish it. Unless you're Russia, unless you're the Soviet Union, but in our system, and similarly, I think with Facebook and with Google, especially, but Amazon, Apple, you can't impoverish these companies, nor would you want to. So I agree with you; they're going to land on their feet. The question is their profitability going to take a big ding in the near future?
Yeah. Yeah, you don't want to overplay, and we always say we like to use the Standard & Poor's recommended industry allocation in a portfolio. So there's so much that's recommended toward technology, and it's one of the highest. But I believe right now it's still only 19% of the portfolio, so it's not 80. We still have a lot of other things. Now, communication is kind of, some of these companies like Facebook and Google are now no longer considered per se technology companies. They're communications companies. They redefined that. So, but in communication carries about a 16% weight. So between the technology and the communication, you're still nothing like what's happened to the S&P 500, where companies like Apple and Google and Facebook now represent 39% of the overall S&P 500 is in these FANG stocks. So you're basically buying an aggressive growth portfolio in the S&P 500. You have to be a little careful of that too.
Yeah, that's a big criticism of the S&P especially. Let me get you to comment on something. I think our listeners who are pretty savvy, are familiar with this ongoing debate that's been going on for at least a couple of decades. One could argue 4 decades, but a lot more, I think, in the past 10 years. And that's the extent to which they should have an investment advisor such as you, whose primary focus is on saying, look, I can't pick individual stocks. I'm not going to try. The best I can do for you is to assure that you're properly balanced and that you're in the proper indexes, and that maybe we do some hedging. But the point is, we're not going to try to be stock pickers. We're going to surrender. We're going to surrender to the market. And so it's heavily indexed. That's the dominant school of thought. And let me just mention the other real quickly, and then because I want your thoughts. And then the alternative is what people used to think, that when they hired a money manager, they used to all think that they were hiring someone to pick stocks. And maybe it wasn't the person they hired. Maybe it was the experts in New York City. But they thought that there was stock picking going on, selecting particular companies, which that was true, many years ago. But now I think that's generally not true. And so I wonder your philosophy. I can tell from comments you've made that you see some particular industries that you like and that you have confidence in. And this doesn't sound like somebody who's simply buying indexes. So give me your thoughts on that as a money manager.
Well, you picked up correctly. I like to build portfolios for my clients that are similar to my own personal portfolio. I use mutual funds. They're still the majority of our portfolios. We also use ETFs, and a lot of times when we're looking at ETFs, by the way, this year we do not think is a good year for what's called passive investing. This year, as we start to come out of the pandemic, hopefully, or maybe not, depending on what happens, I think selectivity is still important, but
that's due to the pandemic, you're saying?
It's just due to, we need to plan for multiple scenarios right now, because I don't know how well this vaccine is going to work.
Yeah.
You just have to be a little bit flexible. But we do like to build portfolios that have some individual common stocks, typically around 20% is in individual common stocks, and roughly 60-70% in ETFs and mutual funds, and then maybe another 10 in potentially hedge products, depending on the client and how we talk about their risk tolerance. I believe that part of the reason why you see so many portfolios in mutual funds is not because they're better necessarily, all mutual funds. It's just easier. It's easier for the advisor. to just throw it in mutual funds and be done with it.
And when you say mutual funds, really those are more index, right, based?
Indexed or active. I'm telling you this year, so our best mutual funds by quite a bit were active. We do both in portfolios, but the active, the ones that kind of anticipated what was going on with the COVID scenario and built accordingly.
Well, you chose well, because isn't it generally true that, and even over the last year, that those that were more broadly based, like an index fund, I think people know what we're talking about. I like to really err on the side on this show, Louis, as you know. I like to err on the side of making things really simple, so that we don't just make assumptions like a lot of financial shows do, or when they have financial guests. So the people who are listening that know this stuff secondhand, bear with me. But just tell real briefly kind of what an index fund is versus one that such as the mutual fund you mentioned.
Right. So an index fund is a fund that buys an index, something that represents a broad stroke of a particular part of the economy, or maybe a broad stroke of the stock market as a whole, like the S&P 500, which is a relatively narrow index that buys the 500 largest capitalized companies that trade as a stock. So instead of trying to have some manager to manage this or that, they just buy the entire index, and the index has, in most situations, has outperformed the actively managed mutual fund. And it's something like 73% of mutual funds cannot show that they consistently can beat the S&P 500. So it's easy to buy something of that nature, an S&P at 500. You can either do that through a mutual fund, which is basically it trades like an exchange traded fund. It's almost identical if it's a fixed mutual fund that buys the S&P, or most of the time you would do it through an ETF, an exchange trade fund, which is, think of it as a stock, and that stock represents the S&P 500, or it represents the Russell 2000, which is another index that's out there. And so but it stays there. It stays there no matter what's happening. So if there's a big star that's about ready to hit the United States, I don't know, it still stays there, okay, and it stays put. Whereas some of the there are those that say, okay, we're going to basically represent this concept, but we're going to invest toward how we think that concept would best be utilized given current situations. That's what's called an active ETF, or an active manager, versus a passive, which is the guy who just buys the index and just stays there with it. Depending on the year, we recommend one or the other. This is one year we are saying that we think that active will probably be better than passive, but who knows? We'll find out.
And there's also a difference, though, in the cost. Sometimes if you go with an index, it means that there's no thinking involved, that you don't have anybody who is an analyst, for example, looking at it and asking questions. Instead, it's simply you could have had a clerk at the stock exchange just go through and buy you 10% of every company, or a 0.5% of every company. In other words, it's not intended to be a thoughtful analysis. It's just buying the whole index, so that this way you know that whatever the S&P does, that's how much profit you've made. So whatever percent S&P went up or down, that's exactly what will be reflected in your account. And as you might expect, you pay less for that, but you don't get any analysis with it.
Right. I mean, of course, I'm going to say this. I think there's a misunderstanding for where fees have evolved in our industry. You're paying less, but you're not. You're talking about the difference between, maybe 0.75% and 8 basis points, so 0.67 and 1%. Maybe that's about what you're looking at here in today's days. Okay, not in the old days, but in today's days.
I want to be sure people get it. So when we talk about 100 basis points, we're talking about 1%. So you're saying the difference sometimes between the totally passive clerical manager, which is somebody who just buys the index, that you might pay 75 basis points, whereas you can get some management thrown in there for, say, 85 basis points.
And even a managed ETF or a managed mutual fund, and forget about someone like myself, those are out there now these days at about 40 basis points, whereas the S&P 500 is probably out there for 8 or 7 or 6 basis points. And that's, so when I say basis points, I'm saying 0.6%. We're talking about a very small number here.
Yeah, right. Remember, 100 basis points is 1%.
Yeah, right.
6 basis points?
Right. That's what you're going to get.
I hadn't heard that.
Yeah, that's what an ETF, the S&P Vanguard ETF, I believe, is 6 or 7 basis points.
You tell how much I follow this.
Right.
So you're saying that by being willing to go from, say, 6 basis points or 10 basis points, going up to what the example used, 80 basis
Let's
points.
say 80. Quite frankly, if you just want to compare the S&P to the S&P, you can cut that 80 in half on a managed smart ETF these days.
So you're saying then what you suggest and what you guys do apparently is you are a believer in indexes to some extent.
Yeah, for sure.
But you want the ability to reach in and grab opportunities. You want to be able to, if you see an industry, let me use one, I'm going to get your opinion about it. I've sat and watched, and people who listen to the show have heard me say this in the last 4 months. You know, I've looked at what's happened with the cruise industry and the hotel industry, and maybe it's gone up just very recently, but throughout the fall of last year, I was saying, look, there's no way that the cruise industry is going away, and there's no way that hotels are going to go away. And I just thought it was such a marvelous investment. I wasn't investing in the market at the time, but if I were, I would think that's an example where I am generally a believer in indexes, but like you say, there are some things that you want to use your judgment and analysis. What did you think about those particular industries, for example?
Joe, I mean, I think it was first off, I think we need to back up from there. If we couldn't see video conferencing coming on stage, if we couldn't see things that are necessary for stay-at-home to occur, then we're just checking in and going to the golf course, okay?
Yeah.
There were a lot. This was probably the easiest to identify what this pandemic was going to do as far as buying patterns. We weren't going to go to the big gym, right? We were going to buy a bicycle and put it in some
Peloton,
sort.
yeah.
I mean, there's so many things. We were going to go camping instead of going. You could see it. You could see it coming.
Or go to Home Depot, like you mentioned.
At Lowe's, you could search Sherwin-Williams. By golly, I think everybody in the pandemic just woke up and said, let's paint something.
Now, this is a good example then. So you're saying that if you were one of those money managers, and this is the majority, I'm not picking on most people in this industry, but I'm telling you, if you talk to whoever's managing your money, I'm willing to bet that the vast majority of you will get an answer if the person is pressed that there's probably some automated system that is making their buys and sells in the central offices, and it's probably relied almost entirely on an index of some sort. And I'm not saying that's irresponsible. You know, there are experts who say, look, that's all you should do because it's the best you can hope to do. There's that school of thought. But what we're talking about is saying in addition to that, supplementing it with observations. And this is a good example. If you had just a straight index last year, you did well. You did well because the whole market did well.
The S&P 500 did well. Now, that you're making the assumption that your index was the S&P 500. Actually, the Dow, the Russell, they didn't do near as well as the S&P. But the S&P, what is the S&P? They're concentrated in those areas that did well in stay-home situations.
And that's a good point, is that whenever you say index, you want to say what index, because index normally will refer to a broad swath of the market. And the S&P arguably is really choosing what ended up being the best of the year. So it was fortunate if you had an index last year and it was S&P. But remember, most indexes are just saying, look, a large swath of the market, whether it's through the Russell's funds or it's through New York Stock Exchange. And those means you have a lot of laggards who are pulling your numbers down. So if you're just blindly doing the index, you still did well. But what if, in addition to that, you said, let's go ahead and focus on these industries that you just mentioned?
Right.
There are circumstances where you want a money manager who's going to think and who's going to have an analyst. Maybe your money manager himself is not the analyst. Matter of fact, that's unusual if they're the smartest guys in their business. Usually they'll have what they call
Teams
quants.
put together, yep.
Yeah, they'll call these guys quants. Yeah, these geeks from MIT,
Right.
whose job it is to think about these and identify the industries such as what you mentioned.
Right. I think that most of your portfolio needs to be built on things like S&P 500 indexes, and there needs to be a majority of the foothold, the line, the offensive, defensive line. You have to also have some flexibility in there. And the only real analysis that occurs is they will look closely at mutual funds and say which mutual funds maybe are falling out of some sort of a grading system because maybe they're creeping their style, they call it. So I hired you to be a small company, value oriented, and all of a sudden you're trying to creep your yield and find something else so that maybe you can become more relevant. Oops, you're gone. We spotted you. We got you out of there. So there are some positions that are moved that way, and the rest of it's really just rebalancing. We want to be 60-40. We want to stay 60-40, and so that's really the world that is. It's a pretty simple world, quite frankly, and it's effective. And we use it with a big percent of our portfolios, but we allow for that extra 20 to 25%, and we've been able to do that effectively.
Very good, Jill. Are we out of time?
We certainly are.
See, this is one of the things I count on Jill for, among many things, but she'll call my attention to when perhaps I'm getting involved in a discussion and we're running out of time. So she kind of gave me that indication a moment ago.
But I'm sure Louis will come back so we can continue this discussion.
Yep.
Am I right?
You let me talk about my process for investing. This is almost like a commercial for me here, by golly.
And and it works well because I think it's wonderful for our listeners. And I always like to say this when I have guests on. Whenever we make a recommendation or we speak well of somebody that's on this show or maybe even somebody who's not on this show, I can tell you that with respect to our guests, we have on guests who we think are going to be useful to you. We have no financial relationship with any of our guests. So whenever I have somebody on and I think what they're doing is great or they talk about what they're doing, the one advantage you have with this show is you know that it's never a commercial. You know that it's never something that we do to generate money by having guests on. And unfortunately, that's become a lot of what podcasts are.
Right.
As you see in effect what is a situation where a guest is paying to be on there, et cetera. So I think one reason we have the audience that we have is that they know when we have people on like Louis that we like them, we trust them, we have good things to say about them, and that's the reason they're here, not because of a financial relationship.
Right. No connection there.
Good deal. Louis, we look forward to having you back.
Thanks, you guys. Thanks, Jill. Thanks, Joe.
It's been another episode of Elder Talk. Till next time, take care.
You've been listening to Elder Talk with TuckerAllen, providing intelligent answers for those thinking about their future, with Attorney-CPA Joe Cordell. Sponsored by TuckerAllen, your estate and elder law advisors. For more information, visit TuckerAllen.com. Listen again next Saturday for another edition of Elder Talk with TuckerAllen. The choice of a lawyer is an important decision and should not be based solely on advertisements.